Hey, my name is Jack Warner. Today I'm going over lesson 5.2 of step 5, investing in retirement. And through this lesson, I'm going to show you the importance of investing for retirement and why we need to start investing in retirement no matter what age. Even if we haven't started and we're almost 60, we should start investing into our retirement accounts. So investing while we are young and staying in the market will produce the best results. So there's a difference between the two mantras of investing. Time in the market, so investing early and often, starting young, investing as much as we can while we're young. If you're not young anymore, or if you don't consider yourself young, then start investing now. There's always a good time to start. And today is a great day to start investing now. Even if you can't do anything else, invest in retirement. The get rich slow scheme or strategy, I should say, not really a scheme, is often the safest and most productive way to build wealth. It's the best approach to build wealth. Getting rich slow, build and hold strategy often beats out most other strategies. And you can Google this too. Get rich slow. There's a lot of different blogs and research done on this to help solidify our investing plan. So conservative or boring investing strategies usually produce the best results. So the difference between time in the market and, of course, timing the market. So time in the market is what we're aiming for with our retirement account investments, while timing the market is maybe something we can play around with outside of our retirement investments. So a little bit of money we left over to do something else to have fun. So timing the market, you're trying to beat the market. You're trying to find a stock that's dipped low, buy it low, and it goes high, then you can sell it. So day traders fall into this category. People that are buying and selling quickly usually fall into this category. Bitcoin investing falls into this category. So we're all trying to, when you're timing the market, we're all trying to beat the market and get the best returns. And usually people fall into this category of timing the market. They're trying to get rich quick. They don't want to play the slow game. They're wanting to see results now. The only downside to timing the market is first of all, very few people can actually do this. In fact, there's a study. I don't remember what they took 100 economists and stock traders, some of the best ones out there, a few years ago, several years ago, and they put them all in a room and played this investing game. And they put a cat in another room, and the cat used their paw to pick which stocks they're going to choose. The cat ended up beating almost every one of them. I think like 8 or 9 investors had beat, and these were top tier investors. 8 or 9 investors, stock traders, whatever they were, economists. They may have beaten the cat, but the cat beat almost everybody else. So there's a lot of randomness to try to time the market. So not many people can actually beat the market, and most lose who try to play. But it is fun. I'll have to admit, it's fun to take a percentage of our non-retirement investing funds and put them into some fun timing the market stocks and stuff and seeing what you can do. But it's just like going to the casino and putting something on the roulette table and putting it all on black. I mean, it's the same thing. It's the same concept as that. So most day trading or short-term investing, which usually revolves around less than 2 years of investing, is subject to capital gains tax, which can be pretty high, especially if you're earning income and then you have a capital gains tax on top of that. That's a huge chunk that's going to eat away at your return, plus the high risk involved in all that too. So I want to show you some graphs to show how productive investing in the long game is, investing slow and getting rich slow, and how safe it can be. Because again, I think some people, the psychology behind investing, some people are a little timid to get involved in the stock market because they hear all the time, oh, the stock market's dipped or it crashed 500 points. But if we look at the long term effects of the stock market, usually it's pretty good. First of all, this first graph, I'll show you the site I got this from here in a second. This first graph, I put in my initial investment into a retirement fund, just some generic fund, at $1,000. So my initial investment was $1,000, and I'm going to put in at least $6,000 over the year. And you can make this as much as you want. I just put 6,000 because that's the max the IRS will allow you to, and I'll cover that more in the next lesson. And I got a very conservative interest rate of 6%. Usually you can get much higher than that, but I'm going to play it safe. So I'm earning an interest rate or some kind of return rate of 6%. And the years I'm going to be invested is 10 years. So each year, if I continue to put $6,000 in and earning a steady return rate of 6%, at 10 years, my money, my initial investment plus my yearly deposits, I'm going to have over $80,000. So I'll have earned almost $20,000 in interest. And that's just with savings. That's not, I'm not having invested in something. That's just, I'm building up interest rate depending on, what I put it in, probably bonds or something with this market. So that's very safe. That's like the most safe I could do it. So even on the safe side, the most conservative side of investing, I'm still earning a good bit of money and I'm saving a lot for my retirement. And it's very low too. I can put in a lot more. And this shows different comparisons of just $10,000. So we're starting out right here in this column. If I just invested $10,000, what does that look like from year 0 all the way to year 15? And we can compare to different return rates to all the way to 10%. So if we're looking here, we can double our money. Let's just say the best case scenario, because we always hope that we can get the best case scenario, 10% return. I can double my money in 8 years without putting anything else in. So I just put $10,000 in on year 1. I left it alone. I forgot about it. I forgot my login, whatever. And I look back 8 years. I'm like, oh my gosh, I made double my money, $21,000. And you can see different rates here. And of course, you can play around with this. And this is where I got it from, dollartimes.com. And there's plenty other of interest and return calculators if you put $10,000 or $20,000 in or whatever. There's some even more complex ones in this. This is very simplified. So another graph I want to show you. The third graph is 10 years of the S&P 500, a Standard & Poor's 500 growth. And if you don't know what the S&P 500 is, basically it is the top 500 companies in one index under the S&P 500. It's the top 500 companies in the United States that trade openly on the stock market. And it puts them all into one collective index, and it shows the score here, the points over here, 2 to 6,000. And this is just the past 10 years, so 10 years of growth. So really, if you invested at any time in the last 10 years, even with all the dips, even with the 2008, oh, it's not on here, never mind. Even with the 2020 COVID-19 dip, the dip that we are in now, you would still have made money. If I put my money in there, if I put my money over here, I still would have earned a decent return over time. So if I stretch this out further, 20 years, 30 years, it still shows growth. And again, you can look up historical analysis, I think all the way to like 1880s or something, or 1900s. I think some of them are capped off at like 1913. But you can look up the S&P 500 or the NASDAQ. The historical NASDAQ, I think, starts in the 70s or 80s. And you can look up the Dow Jones dating back to the early 1900s too. And it's always a trending growth. It's always going. There's going to be some dips in the road for sure because certain economic factors during those times. But it's always going to be a steady growth. So no matter where you invest your money, you're most likely going to earn money unless the economy collapses. And if the economy collapses, that means you're not going to worry about cash. So another thing I want to touch on is we can't depend on the government. We can't depend on Social Security. Social Security and any other kind of retirement assisted funding from the government is not enough. If you're counting on Social Security to be your main source of income in your retirement, we're fooling ourselves basically. Social Security, especially those of us that are under 50 right now, it's not going to be enough for us to live on. Even people retiring now, I hear, can barely make ends meet. They can barely pay their rent, or they can barely pay their home mortgage, or maybe thankfully they're out of debt. They can't travel. They're just stuck. They retired and now they can't really do much because they're not getting much money, especially because of inflation. So don't count on Social Security. I'm not even thinking it's going to be there when I retire. So I'm not counting on it at all. We have to invest in ourselves. Focus on that first. So why investing in retirement is good, even if we don't plan on retiring. So some people are like, well, I don't care about retirement. I want to work, or maybe I want to retire now and worry about it later, whatever it is. Still, investing in retirement accounts helps us with our lives because, first of all, it helps us with our financial plan, part of the budgeting process. It is another tool to help build wealth. And all retirement investing has great tax benefits. Almost every different investing style into a retirement account, you get a good tax shelter. And we're going to discuss more of that in the next lesson. And of course, this helps us support our financial goals. So maybe we don't plan on retiring, or maybe we just can't foresee ourselves retiring. Still invest in retirement because it can still help us reach our financial goals because we can grow that money and build wealth. And lastly, just going over what should we target when we are investing. And this is part of your budgeting process. We need to aim for at least 10 to, I'd argue 15%, but depending on your financial situation, maybe you can only allocate 10%, but at least 15% of our income into our retirement account each year. So you have your other stuff that's going on to pay off your budget, your debt, whatever. 15% of your income into our retirement account each year. If you can do more, then definitely do that. Do much more, as much as you can, max it out as possible, as much as possible. But only invest. Important thing here is only invest once consumer debt is paid off. The math just does not add up. If you try to keep your credit card debt floating or whatever, and you're still investing in retirement, focus on paying off that consumer debt, that car loan, that personal loan, that credit card loan, student loan. Pay off those loans first, and then you can start paying off your retirement. So pause retirement investing. You won't be able to earn enough anyway, and interest or returns to balance out the debt owed plus the interest owed. Plus, this gives you an incentive to focus down on getting out of debt. Then all the debt payments turn into retirement investment payments. So once your debt is gone and eliminated, then you can repurpose that, what was those debt payments, and that can go straight into your retirement plan. And then always try to max out your contributions wherever possible. 401ks, IRAs, health savings accounts. We're going to be talking about this next lesson, but try to max the biggest benefit you can do is maxing out these contributions in all these accounts, or multiple accounts if you're blessed enough to have multiple accounts. Try to max out those contributions and take advantage of the tax system there. So next lesson, we will go over how exactly to invest for retirement, how to open up different accounts. We'll compare and contrast different accounts. I'll show you some strategies involved in investing for retirement, and maybe some different apps and online banks and financial institutions that we can invest through. See you then.